Hey everyone, it's Julie here with TipRanks, and today we're taking a look at 3 strong buy manufacturing stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at stocks in the manufacturing industry. This is a sector that many are anticipating to benefit from the upcoming administration. So today we found 3 companies all rated a strong buy with price targets that would imply some double-digit upside potential. We're going to take a look at these companies, what it is that they do, and of course what those analysts are predicting for the stock's future. Just before we get into that, I want to remind you that next week we do have Christmas coming up. I will still be here a couple times throughout the week, but we'll be taking a few days off to spend some time with my friends and family over the holidays. I hope we're able to do the same, but just a heads up that we will be off for a few days next week. Just before we get into today's stocks, this is a friendly reminder that if you enjoy the video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's jump right into these 3 strong buy manufacturing stocks. First up is a company called Regald Rexnord. They trade under the ticker RRX, currently priced at $155 per share. Over the past year, they have gained 8% and are up 11% in the last 6 months, though have cooled off recently, down 8% in the last 3. Regald Rexnord is a specialized manufacturing company that produces tools and technology that power, transmit, and control motion. They are primarily a maker of a wide range of electric motors, industrial powertrains, and air-moving subsystems. The company's product portfolio also contains power transmission components, automation controls and actuators, and precision motors. This lineup of motors and power transmission products has applications in an even wider array of end markets. They find their customers in niches from factory automation to warehousing, with the aerospace, alternative energy, construction, data center, medical, mining, and general industrial sectors. They shared their third quarter earnings report on November 4th, where they did have mixed results, reporting a beat on earnings but a slight miss on revenue. For their Q3, they saw earnings per share of $2.49, beating estimates by 1 cent per share, while revenue came in about $50 million short of estimates at $1.47 billion. The company did pay down $114 million of gross debt and had adjusted free cash flow of over $125 million. The company did lower some of their future guidance, saying that it reflected weaker factory automation demand in the automation and motion control sector, but management did say that despite some persistent near-term market headwinds, they see significant value creation opportunities before them. And just a week ago, we did have an analyst at Jefferies initiate coverage on the stock with a buy rating, saying that they see a recovery in manufacturing sentiment bolstered by the potential for lower interest rates, reduced corporate taxes, and deregulation. In the context of this view, they say that Regald Rexnord now has been diversified into a top-tier industrial with a clear path to 40% margins. Stronger underlying growth and tailwinds from delevering should drive mid-teens earning per share growth through 2027. With 8 current analyst ratings, the Regald Rexnord stock does come in as a unanimous strong buy. And analysts' average price target of $204 would imply an upside potential of over 31.5%. Looking at those ratings down below, we do have several analysts recently bumping up price targets as well. Our low-end price target does come in at $191 for an upside of 23%, while our high-end price target is $220 for an upside of over 41%. Second on the list today is ITT. Trading under the ticker ITT, they're currently priced at $143 per share, having climbed nearly 25% over the past year, up over 10% in the last 6 months, dipping ever so slightly in the last 3, down less than 1%. ITT manufactures highly engineered critical components and customizable technology solutions. They play a significant role in the industrial, transportation, and energy sectors by providing essential components and services that improve operational efficiency, safety, and environmental sustainability. Their industrial process segment is known for their pumps and valves, including their Gold's Pumps brands, which are used across industries like chemical, oil and gas, pulp, and paper. They also have their motion technology segment, which is involved in brake components, shock absorbers, and damping technologies, and their connect and control technologies segment for connectors and energy absorption components. They shared their Q3 earnings report on October 29th and had a few more highlights, including an earnings and revenue beat, record backlog and order growth, and an increase to their full-year guidance. During the quarter, their orders grew 14% organically with a record backlog of $1.7 billion, and they also saw some strong margin expansion and significant earnings per share growth. The Q3 earnings per share came in at $1.46, beating estimates by 2 cents per share, while revenue grew 8% year over year, coming in at $885 million, beating by over $1.2 million. Management said that given these strong results, they're raising their midpoint of their full-year earnings per share outlook, excluding their temporary acquisition amortization. They're driving to over $6 of earnings in 2024. Earlier this month, we did have an analyst from Citi increase their price target on the ITT stock, saying that with an upcoming change in U.S. administration, Citi remains selectively bullish on multi-industry companies as divergent market trends among industrial verticals could continue for the time being. The firm says exposure to secular growth themes could remain at a premium, and it also favors selective exposure to emerging tailwinds such as Trump beneficiaries, value, and tactical short-cycle exposure. With 10 current analyst ratings, the stock does come in as a strong buy based on 8 buys and 2 holds. The average price target comes in at $167, implying an upside potential of about 17% from current prices. Looking down below, on the low end, we do have a hold rating here back in October with an upside just shy of 5%, while our Citi analyst here is the high-end price target at $183 for an upside of nearly 28%. If you've made it all the way to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Last but not least, we're looking at Valmont Industries. Trading under the ticker VMI, they're currently priced just shy of $307 per share after climbing 36% in the past year. In the last 6 months, they've gained over 13% and are up 9% over the last 3. Valmont is a global leader in the design and manufacturing of engineered products for the infrastructure and agricultural industries. In the agricultural world, under their Valley brand, Valmont is a leading manufacturer of center pivot and linear irrigation systems, helping farmers irrigate crops more efficiently. They also have their ag tech, which includes advanced technology solutions like crop anomaly detection and precision irrigation technologies. On the infrastructure side, they produce steel, prepressed concrete, composite, and hybrid structures for electrical transmission and distribution. They manufacture poles for street and highway lighting, traffic signals, and also produce steel energy generation structures and engineered solar tracking solutions. They shared their Q3 earnings report back on October 22nd, where we did see mixed results with an earnings beat and a slight miss on revenue. During the quarter, they did see their net sales of $1 billion decrease by nearly 3% due to a lower sales in Brazil, but the company did have solid operating performance with strong cash flow of $225 million. Their earnings per share of $4.11 beat analyst expectations by 11 cents per share. That revenue of $1 billion was just $20 million short of analyst expectations. Management said that looking forward, they were reaffirming their full-year net sales and earnings per share outlook. Following that earnings report, a 5-star analyst from D.A. Davidson did reiterate their buy rating. They said the company's earning growth could ultimately accelerate as its agricultural segment eventually lends more momentum, though in the meantime, their healthy cash flow and earnings growth is still supported by the infrastructure segment. Now, the Valmont stock does just have 3 analysts currently weighing in, but all 3 of them do rate the stock a buy. And their average price target comes in at $365, implying an upside potential of 19%. Looking at those ratings down below, the low end is $335 for an upside of 9%, while our high end is $382 from Stifel Nicholas for an upside of over 24%. So that is a quick look at 3 strong buy stocks in the manufacturing industry. Let me know your thoughts on these stocks in the comments down below. I always love hearing from you guys. And of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock. Please make sure you always stick to your own investing plan and always do your own research and due diligence. Thank you guys so much for watching. I hope you have a wonderful day, and I'll see you back here next time.